If you own a home care agency, should your business be a sole proprietorship, an LLC, a partnership, an S corporation, or a C corporation? If you've searched for the answer online, you may have walked away even more confused because you'll hear things like just form an LLC or once you make enough money, become an S corporation or an S corporation will save you money on taxes. But here's what I want you to understand. There isn't one business structure that's automatically best for every home care agency. The better question is which business structure makes the most sense for your home care agency based on where your business is today and where it's going. I'm an enrolled agent with over 14 years of experience helping business owners navigate taxes, accounting, and IRS roles. And throughout this series, we've talked about different business structures, how they are taxed, and even how the owners pay themselves. Today, we're bringing everything together. And the first thing I want you to understand is that your legal business structure and your federal tax classification are not necessarily the same thing. This distinction is incredibly important. An LLC, for example, is created under state law. But simply telling me I'm an LLC doesn't necessarily tell me how your business is taxed. If you're the only owner, a single member LLC is generally disregarded for federal income tax purposes unless it elects a different tax treatment. That means the business activity is generally reported on Schedule C of your individual tax return. If your LLC has two or more owners, it's generally taxed as a partnership unless it elects another tax classification. And an eligible LLC can also elect to be taxed as an S corporation. So when someone tells me I'm an LLC, one of my next questions is, okay, how is your LLC taxed? Because those are two different questions. Once you understand that, choosing the right structure becomes much easier to think about. So let's walk through the questions I want you to consider. First, how many people own the business? Ownership matters. If you're the only owner, your options look different from a home care agency owned by two people. If you operate the business by yourself without forming another entity, you're generally operating as a sole proprietor. If you form a single member LLC, you now have an LLC under state law, but you're generally still taxed like a sole proprietor for federal income tax purposes unless you make another election. If two or more people own the business, partnership taxation may come into the picture. So before asking which structure will save me the most money, start with who actually owns the business. Second, don't look at taxes alone. Taxes are important, but your business structure is also a legal decision. Think about the type of business you operate. You own a home care agency. You may have caregivers going into clients' homes. You may have employees. You may have contracts. You may have payroll. You're operating a real business with real business risks. So I don't want you choosing a structure only because someone told you it gives you better tax deductions. Your tax professional can help you understand the tax consequences, but liability protection, ownership agreements, and other legal considerations may require conversation with an attorney. Third, look at your net profit. And notice I said net profit, not revenue. If your home care agency brings in $500,000, that doesn't mean you made $500,000. You may have caregiver wages, payroll taxes, insurance, software, marketing, professional fees, and many other business expenses. What we're interested in is what remains after your business expenses are taken into account. That's your net business profit. And this becomes especially important when you're considering an S corporation. As we discussed earlier, you may hear $40,000 to $50,000 of net profit discussed as a point where a business owner can begin having the S corporation conversation. But that's not an IRS rule. It's a starting point for analysis, because the real question isn't simply, did you cross a certain number? The real question is, will the potential tax benefit justify the additional cost and complexity of operating a S corporation? You now have payroll. You have a separate business tax return. You have reasonable compensation to consider. You may have additional state requirements, and you have to operate the S corporation correctly. So don't choose an S corporation simply because you cross a particular income number. It's important that you run the numbers. Fourth, ask how your business actually makes its money. This is something business owners don't hear enough. Let's say two agencies each have $150,000 of net profit. Jane owns the first agency. She's heavily involved in the day-to-day work. She's managing caregivers. She's handling scheduling. She's communicating with clients. She's marketing the agency, and she's managing operations. A large part of what happens inside the business depends on the work Jane personally performs. Now, imagine another home care agency with the same $150,000 of net profit, but this owner operates very differently. She has an administrator, she has a scheduler, she has employees performing the care, she has management, systems, and a team in place handling much of the day-to-day work. So instead of personally performing all of those roles, this owner spends much more of her time overseeing the business and working on the business rather than working in every part of it. Same net profit, very different owner involvement. And that's important when evaluating an S corporation, because if you work in your S corporation, your reasonable compensation needs to reflect the value of the services you actually perform. Remember the replacement question we discussed? If you stepped away tomorrow, what would the business have to pay someone to replace the work you perform? So yes, profitability matters, but how that profit is being generated matters too. Fifth, consider the cost of complexity. I don't want you thinking that a more complicated business structure means you have a more successful business. Sometimes simplicity has real value. A sole proprietor has relatively simple federal income tax reporting. A single member LLC can generally keep that same simple federal income tax treatment while operating as a separate legal entity under state law. A partnership generally introduces a separate partnership tax return, and an S corporation introduces its own tax return, payroll considerations, reasonable compensation, and additional compliance. And a C corporation has a different tax system altogether. So don't ask, what's the most advanced structure I can choose? Ask, does the benefit I'm receiving justify the complexity I'm adding? Because every additional layer of complexity has a cost. And here is one more thing that may take some pressure off this decision. Your business structure can change. The structure that makes sense for your home care agency today may not be the structure that makes sense 3 years from now. You might begin as a sole proprietor. You may later form an LLC. And as the business business grows and the numbers support it, that LLC may eventually elect S corporation taxation. Your business didn't fail because the structure changed. Your business evolved. So your business structure should support the business you actually have today while also considering where you're going. So which business structure is right for your home care agency? Here is what I want you to remember. There isn't one answer that fits every agency. Look at who owns the business, look at your net profit, look at how that profit is being generated. Look at how you're paying yourself. Look at your state, your future plans, and look at the cost of maintaining the structure you're considering. Then run the numbers, because the right business structure isn't necessarily the one that sounds the most sophisticated. It isn't automatically the one someone recommends on social media. It's a structure that makes sense for your business, your numbers, and your circumstances. And with that, we've reached the end of our How to Pay Yourself and Your Team the Right Way series. And if there is one thing I hope you take away from this series, it's that how you pay yourself isn't something you should simply guess at. It depends on how your business is structured, how it's taxed, and where your business is today. Because my goal isn't for you to memorize tax terminology. My goal is for you to understand your business well enough to ask the right questions before making important tax decisions. If you're a home care agency owner and you're not sure whether your current business structure still makes sense, this is exactly the type of analysis I can help you with. You'll find my information in the description below. And make sure you're subscribed, because our next video, we are starting a brand new tax series for home care agency owners. I'll see you there.